Hi, it's Zane from Saxo Bank, and this is Digital Investing 101, a masterclass where you make more franc with your bank. Last time, we talked about managed portfolios and the benefits they bring you. But what if you're looking to take complete control over your portfolio? If the answer is yes, and you're comfortable in the driving seat, let me show you your new car. First step is to open an online brokerage account. How do you do that? Well, many solutions nowadays, like the one we have at Saxo Bank, are completely digital. So you can do it from the comfort of your home, the comfort of your phone, and smash it out in a couple of minutes. The strategy, of course, is the next important thing. There's a couple of ways to define what you're going to invest in. You can start by watching videos, films, podcasts. Another thing could be understanding what you value as an individual. So are you somebody who cares about only returns? Or are you also looking for a fiscal and a social return? So ESG or ethical investing. Diversifying your exposure is also very important. Don't put all of your eggs in one basket. It's exactly the same with investing. So spread it over different currencies, industries, asset classes, companies, countries. So the more diversification you have, the less possible risk you have on your account. First things first, you have complete access to all the products, asset classes that you want, and you define the strategy. So whatever goes in your portfolio is what you want. So it's super personalized and super tailored. Another thing is, you're not paying for a private banker to give you the research or to give you suggestions or advice. So no need to pay these exorbitant fees. The fee structure, therefore, of DIY is much cheaper. Also, when it comes to risk mitigation, with a lot of asset managers and wealth managers, they generally don't pay to manage the risk because you have to pay a premium for it. So this way, your account is in your hands, you're accountable. Like they say, nobody can take care of your business better than you can. Nobody can take care of your portfolio better than you can. Many individuals can think that when they have their funds or their money with a bank or a wealth manager or a professional, they feel like they have a safety net under them. There's some benefit from having years of experience behind you, but it's not always the case. Another thing is the time it takes. So you then need to sort of scour the internet or read newspapers or read journals. So people think that it takes a lot of time, and sometimes it does. Personally, I learn through audio. So I like podcasts or videos or webinars, so I can literally hear the professionals or the individuals give their opinions. Other people may prefer looking at statistics or financial statements. They may also prefer technical analysis, so actually looking at the graphs. But really, all sources are your best friend when it comes to research. The more you have and the more you do, the better you know, and I guess hopefully the clearer picture you have on the market. Diversification is a tricky task. Technically, we have a lot of quantitative analysts who say you need at least 30 stocks to eliminate systematic risk. Let's just make it a little bit more simple than that. If you have stocks or bonds or ETFs or asset classes that are in different currencies or different industries or different companies, maybe even different time frames, that's diversified enough. So just don't put all your eggs in one basket. If your strategy tells you that you should have 20% in equity, 10% in crypto or in real estate or in fixed income, then stick to those percentages. So if one industry is doing considerably well, it might make sense to take a little bit of that profit in order to stay within the confines of your strategy. One of the easiest ways to manage your risk is a stop loss. It's basically an order that will close your position after you lose a certain amount of money. So if you tell yourself there is a certain limit to the max amount I can lose, put that as your stop loss. You know you're not going to get less than that. So that's one way. Another thing to take into consideration is that markets are cyclical. They're going up and down. So if markets are going up, it may make sense to take some of your profits. If markets are going down and you anticipate it well, it may make sense to maybe be out of the market, or you could also reinvest in position to reduce your purchase price, and hopefully when the market goes back up, you'll make a pretty profit. Does DIY investing make sense for you? Well, if you're an individual who wants to be in control of what they want to invest, they don't want to pay a private banker, if they want to be paying fees which aren't exorbitant and actually extremely affordable, and they want to manage their own risk at their own time, their own phone, definitely DIY investing makes a lot of sense. If you liked what you heard, you want to maybe put your newfound experience to the test, I invite you to check out our platform, Saxo Trader Go. If you have questions, give us a call, send us an email, we're happy to help. And as always, if you want to stay tuned and see our next exciting topics, I invite you to like, share and subscribe. We'll see you soon.